Analysis report on Rezolve AI, that's RZLV. It's a really strong bull thesis. We're talking a potential 300% upside, which is obviously grabbing headlines. It's all based on some aggressive new guidance and their proprietary AI tech.
An incredibly high-stakes thesis for sure. So the analysis has to be just as solid.
Let's jump right in then. So the core of the analysis, pillar A, really hangs on the company's very aggressive guidance. Specifically that $500 million annual recurring revenue target for 2026. It's an exciting story, and it suggests just massive growth potential.
It does, yeah. That picture of potential is painted very clearly. It's why you see analysts screaming strong buy. But if we look at the structure, I have to wonder how the placement of the risks, affects the weight of the whole argument. I think integrating that core execution risk directly into the hypergrowth narrative is absolutely critical for the analytical integrity here.
I see what you're saying. The report mentions the risks, but it feels almost like a boilerplate disclaimer at the very end.
Exactly. And that's the weakness. The biggest risk here, the fact that the company is still burning through cash, over $17 million in EBITDA?
Yeah, it's a lot.
And that they must hit the 2025 target of $150 million ARR just to survive without massive dilution. That whole reality is tucked away in a small section.
Right.
By separating it from the main hypergrowth story, you're presenting this amazing bull case without immediately showing how severe the failure rate could be. It dilutes the stakes.
It turns a high-stakes bet into what feels like a purely optimistic projection. The reader doesn't immediately feel that financial cliff they're standing on if that first benchmark is missed.
Precisely. So the suggestion for improvement is pretty straightforward. You have to elevate that whole discussion of liquidity and execution risk. Make it a necessary counterpoint to that big $500 million target. It ensures the analysis is balanced from the get-go.
And it makes that $150 million milestone feel like what it is, a survival gate, not just another goal.
That's it. When you weave the risk into the core financial argument, the reader understands this isn't just about hitting a high number, it's about avoiding disaster first.
So, okay, we make the risk active, not passive. What does that look like in the actual write-up?
For a concrete example, you should frame that $150 million ARR guidance for 2025 as the crucial execution gate. If that specific gate is missed, then all the later analysis of the $500 million target for 2026 becomes, functionally moot.
Because they'll have to raise capital and dilute everyone. The game changes completely.
The game changes. It instantly raises the stakes. And beyond that, you need to actually model out that dilution to define the downside. Compare the current market cap, about $790 million, against that $17 million plus EBITDA loss. Ask the question, what capital do they need if that target is missed? If it's, say, $50 million they need immediately, what does that do to shareholder equity at the current price of $3.05?
You're calculating the hit.
You're calculating the hit. By doing that, you strengthen the entire conclusion because you've defined the downside boundary. It makes the upside conviction so much more persuasive because it survived a real, quantified stress test.
That's a huge psychological shift. You go from saying, this is high risk, to this is exactly how high the downside risk is, and here is the path to avoid it. That's what separates a real investment thesis from just a promotional piece, right?
Exactly. It validates that potential for 300% upside because you've looked into the abyss and actually measured it.
Okay, that makes perfect sense. Let's shift gears to the tech side, to Pillar B, the brain power moat. The report makes a very strong, data-driven case here. It highlights that their proprietary LLM outperforms GPT-4 in commerce tasks. And that's really backed up by that remarkable 95.8% gross margin figure for the first half of 2025. That number alone kind of shuts down the simple GPT wrapper argument.
Oh, the unit economics are undeniably powerful, yeah. And the analysis does a great job countering that immediate surface-level criticism. But I think it needs to address a bigger, more structural threat. The competitive moat analysis has to rigorously address the long-term threat from their own confirmed strategic partners.
You're talking about Microsoft Azure and Google Cloud? They're listed as distribution partners.
Yes. The weakness is that while the report proves this isn't just a wrapper, it doesn't fully scrutinize the long-term risk of those partnerships. I mean, these are companies that are massively invested in AI and are moving into agentic commerce themselves.
Right.
So if RZLV is relying on them for infrastructure and distribution, the analysis should be asking, could these partners go from being a channel to being a direct competitor? Could they cannibalize RZLV's function down the road?
That's a huge point. Treating those relationships as pure validation ignores just how fast the hyperscalers can internalize a successful technology. The question isn't whether RZLV is better than GPT-4 today, but whether it can survive becoming an Azure feature tomorrow.
That's exactly it. So, the suggestion for improvement is to deepen that competitive analysis. Focus explicitly on channel conflict or technological dependency. You have to establish a clear proprietary lock-in. How does brainpower maintain its lead despite relying on big tech infrastructure?
So we need to find the source of a durable advantage. What makes the moat last?
For concrete examples, you need to specifically define that lock-in. Is it a data advantage? Is brainpower trained on exclusive proprietary commerce data that Azure or Google just can't get?
If it is, that needs to be front and center.
It has to be the focal point of Pillar B. That's the real moat. If the data isn't proprietary, then what's the defense? Is it contractual? And if possible, you have to analyze the likely longevity of these partnerships. Is RZLV's cost structure so specialized that it deters Microsoft or Google from building their own version? Or is RZLV just proving out the market for them, validating a huge opportunity that its partners will inevitably try to capture themselves? If you don't answer that question, the whole tech moat feels a bit soft, even with those incredible margins.
You have to prove it's not just a future Azure feature. That completely recenters the whole argument. Okay, let's move on to the valuation, which is maybe the most compelling part of this whole thesis. We're looking at a really striking discrepancy here. You've got a unanimous 6-buy, 0-sell consensus from analysts, average target around $10, and yet the stock is trading near its all-time lows at $3.05. The analysis calls this the reversal phase.
It is a powerful narrative, that idea of a massive reversal and a stock trading at less than 1x its 2026 revenue if targets are met. It's compelling. But that narrative needs a really robust analytical grounding. To really solidify the strong buy thesis, the report has to analytically bridge the gap between the market's current skepticism and what the analysts are saying.
It feels like the report just asserts the price is wrong, but without fully explaining why the market currently thinks the price is right.
That's the weakness. The reversal story is presented mostly as a visual, a chart, just historical context. It's disconnected from the financials. It says the $3.05 price is absurdly cheap, but it doesn't analytically explain why the market has such low confidence, even with the raised guidance. That market skepticism is a key piece of data that's not being analyzed.
So the suggestion is to tackle that head-on.
Yes, create a distinct section just for that gap. Explicitly analyze the difference between the current discounted valuation and that consensus target. When you quantify the market skepticism, you turn the reversal play from a historical story into a legitimate financial arbitrage opportunity.
That sounds like you're putting a monetary value on the market's doubt. How? How do you actually do that?
Well, you start by quickly analyzing the history. Why did it drop from $10 to $1? Was it just typical de-SPAC fallout or something specific? And then you explain why those factors are now mitigated.
You set the stage.
You set the stage. But here's the most important part, the concrete example. You use valuation metrics to show the implied probability of failure that's already priced into the stock. This is the financial rigor it needs. If the consensus target is $10, you can kind of reverse engineer the math. You ask what percentage of that $500 million ARR target is the market assuming RZLV will hit to justify a $3.05 price today.
That's fascinating. So if the stock is at $3.05 and the target is based on $500 million ARR, the current price might imply the market only thinks they'll get to, 30% or 40% of that target.
Exactly. And that's how you translate abstract market sentiment, low conviction, skepticism into a clear, actionable metric. You can then build an argument that says, look, the market is currently pricing in a 65% probability of execution failure. But given the new guidance and the internal data, we believe the true probability of failure is closer to 20%, which mathematically justifies a price of X.
It makes the conviction rational, not just hopeful. It gives the reader a tangible number to rally behind for that 300% upside argument.
By quantifying the market's current assumption of failure, you frame the whole investment as a statistical anomaly that's just waiting for execution to correct it.
That makes the whole thesis so much stronger.
It sharpens the focus and it maximizes the impact of the entire report.
This has been incredibly focused. I mean, this is feedback aimed at really maximizing the rigor of what is already a very high potential bull case.
Yeah, to summarize the key points, first, integrate that liquidity and execution risk directly into the hypergrowth pillar. Frame the $150 million target as the non-negotiable execution gate.
Right.
Second, deepen the competitive analysis. Stress test that brainpower moat against potential cannibalization from Azure and Google.
And finally, connect the price history to the current valuation.
analytically quantify the market's skepticism to really solidify that reversal play thesis.